Hey guys, it's your girl Marian with MB Elite Realty Group and Brick House Collective Team. Back again today with another video on the most common types of loans that's available out there for you guys who are interested in purchasing a property. So the first loan that we're going to talk about is the FHA loan, which is a Federal Housing Administration Mortgage Insurance Program loan. So FHA loans are insured by the federal government. The department that oversees or is over the FHA loans is the Housing of Urban Development, which most people commonly knows as HUD. With FHA loans, there is a mortgage insurance premium. The mortgage insurance premium protects the lender. With FHA loans, the standards are not as strict as with some of the other loans like conventional or VA loans. Most buyers, not just first-time home buyers, typically start off with an FHA loan. Reason being, down payment amount is a lot less than most loans available. So in an FHA loan, it's usually 3.5% down. So when using an FHA loan to purchase a home, let's say the home is a $200,000 purchase. At 3.5% down, your down payment would be roughly $7,000. Another type of loan that's available is a conventional loan. With a conventional loan, they are not backed by a government entity. The ideal borrowers who borrow with a conventional loan have good or excellent credit, have been on the job for at least 2 years, and have a good debt to income ratio. The debt to income ratio is the amount of debt that the person has versus the amount of income that they bring in, which is why it's called the debt to income ratio. With conventional loans, there's usually a higher down payment. That's the old school of thought. I know now in today's lenders, I've dealt with lenders that provide their buyers, their clients 3%, 5%, I've seen 7% and 10% down. I am not sure what determines the difference between the 3, the 5, the 7, or the 10%. I would assume it's maybe credit or amount of cash available or something to that nature. But I have had clients that come to me from their lender with a conventional loan with 3% down or a conventional loan with 10% down. So if it's a conventional loan with 10% down, looking at the same $200,000 home that you're purchasing, it would be something in the idea of about $20,000 down for that 10%. Looking at an FHA loan, which was $7,000 down with 3.5%. Now there are 3% conventional loans, and those loans would be a little bit less, looking at the FHA versus the conventional at a 3% interest rate. Now, not everyone qualifies for a 3% conventional loan. When looking at the conventional loan versus the FHA loan in the sense of a purchase, when someone is purchasing a home, the FHA buyer is restricted to the type of property that they would be interested in. For instance, condominiums very rarely accept FHA financing when purchasing in the condominium environment. Now, condominiums are apartment type structured condominiums that you would see 3 to 5 to 10, 20 stories high, or either a townhome that's governed by a condominium bylaws. Neither one of those two would accept an FHA loan. So if you're looking for a home that is a condominium, you would be restricted to more than likely a conventional type loan. FHA loans are single family homes, some townhomes, where conventional loans are condominiums, single family homes, multifamily homes, of course, and townhomes. Another type of financing that's available, and it's only available to a certain class of people, which would be the veterans. A veteran loan, which is a VA loan, is backed by the federal government. So for instance, if the borrower was to default on that loan, the federal government would take up on that loan and pay the lender back that money that is owed. In order to qualify for a VA loan, of course, you have to have been a veteran. The borrower should have suitable or good credit, good amount of income, and you have to have your certificate of eligibility, which is called the COE. All right, guys, so when we talk about the veteran the VA loan, which is a veteran loan, it's secured by the U.S. government. So if a borrower, which is a weird word, defaults on that loan, the U.S. government will pay that lender or the mortgage company. They'll secure that loan to make sure they don't lose any money. One of the benefits of being a VA loan, being able to get a VA loan, they receive 100% financing, so they aren't required to make any down payment.